This should be a really good conversation. I've tracked Paul over the years, has a lot of interesting ways of viewing the markets and talking about what's going on as far as day-to-day news. So I think this will be very worthwhile for everybody here. This will be available as a podcast under the Lead Lag Live banner, where I put up pretty much all of these conversations pretty much every single day. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Paul R. LaMonica. Paul, a lot of people have, I'm sure, read your work over the last decade plus here, but introduce yourself a little bit formally. Talk about how you got interested in financial journalism, what kind of work that you do, and what are you doing now?
Yeah, thanks a lot, Michael. Appreciate it. Yeah, I've been at CNN back when it was CNN Money, and now it's CNN Business. Coming up on almost 21 years. I've been a financial journalist since graduating college in 1995. Worked at a couple of publications, some of which no longer exist, like Financial World and Red Herring, Smart Money, also American Banker, which I believe is the one that does still exist. So I didn't jinx them. But yeah, I came out of college at a time where tech stocks were very hot. The market was in a kind of really big bull run, the kind of Alan Greenspan irrational exuberance days. And I wanted to be a journalist, and the jobs in New York City at the time, a lot of them were in financial media. So I didn't necessarily think I was going to be a financial reporter, but it happened. And, 27 years later, I'm still at it. So there you go.
I read a book some time ago. I don't remember the name of it. It'll come to me throughout the conversation, but it argued that in the 90s, when you ended up having 24/7 journalism, financial journalism changed to be much more technically oriented, because even though there may not be something new happening with individual companies, you can always talk about something when it comes to a chart. I'm curious how you've seen the evolution of financial journalism from 1995 to today, if it's become noisier because of the need to constantly have something out there.
Oh, it goes without question that there is a lot more noise and clutter, if you will, because it's just become relentless. I mean, when I started out in 1995, I was working for a print magazine that was just in the beginning stages of setting up an online operation. And then, American Banker was a daily trade publication that, again, also didn't have much of an online presence. But in the late 90s, heading into that 2000 epic NASDAQ collapse, that's when I think you really started to see mainstream media adopt online journalism in a significant way, to the point that it was no longer the afterthought. It was what you really needed to be a leader in order to attract the audience. But at the same time, Michael, yes, that does mean that there's a constant need to feed a beast that doesn't care anymore about column inches and page counts and other print journalism sort of anachronisms. So you're just always needing to chase breaking news and jump on things. And, it can be, could be relentless and tiresome, and we all need to come up for air. But it's, I think, better now to be in a world where if I'm writing about FTX going bankrupt, I can tweet it out within seconds, as opposed to waiting for the next day to see it in print.
Yeah, no, I think there's no question there's validity to that. I guess more the issue from my vantage point is, I think it's, and I don't know sort of if this jives with your own experience, but when I used to do a lot of the media rounds and, would be asked by journalists for thoughts or quotes on different things, oftentimes it felt almost like it was just trying to fill up a screen, even though it's not filling up a printed document, so to speak. And I always found that when it came to financial journalism, financial journalism doesn't necessarily, I think, imply that the person that's doing the story really has a deep dive understanding of market dynamics, history. They're looking at it from a news perspective. And that, I think, becomes problematic for the readers at times, because how do you possibly know if what's being written is analysis, again, as opposed to just noise? Now, I know you have a lot of experience, obviously, and understand markets, but I can understand why there's some skepticism around financial journalism in the way it's being presented today.
No, I think that is fair. And, I think there are a couple of ways around it. I know, for example, at CNN Business, I can't speak for, obviously, for every other publication, but a lot of times when we are doing something that is more of an analysis piece, we will label it as such, either in the headline, the SEO tags, or on the in social media as analysis. And we try as reporters also to take into account that there are some people like myself who have a fair amount of gray in their beard and have been doing this for a long time. And then there are also people who are younger and are working their way into the industry and may not have as much experience. And for those people, for younger journalists, really what it behooves them to do, and this is all journalists, including someone like me who's done this for almost 30 years and is pushing 50 years old. You need to talk to people. Obviously there's a place for commentary and opinion, but our opinions need to be informed by facts and also by smart takes from people like yourself that are in the game, so to speak. Because I take pride in the fact, and some people would find this maybe to be a criticism, I personally just own broad ETFs. The only stock I own is Warner Brothers Discovery in my 401k because it's my parent company. I don't want to be ever in and I do own Abbott and AbbVie because my wife's grandmother used to work at Abbott Labs many, many years ago. And when she passed away, she willed some shares to us. So I try, and I've had stories where like Abbott and AbbVie have asked me to write about them, and I tell them, I'm not going to do it. I own admittedly a tiny stake in the company, but I don't want to be put in a situation where anyone can accuse me of having a vested interest. So I think it behooves a lot of journalists to just make sure that they disclose what they own, because there can be skepticism at times. This doesn't happen as much in this day and age as it did in the 2000s and late 90s. But I remember back when things like the old Raging Bull and Yahoo Finance messaging boards were popular. If you dared to write a story in the late 90s saying that Cisco might be overvalued, everyone would jump on you and accuse you of being in the pockets of short sellers. And it's like, no, I'm just pointing out that maybe a stock with a triple-digit PE is a bit ridiculous. Just saying.
Now, I was saying that the equivalent of the Yahoo message boards, of course, is Twitter, right?
Yes.
And, I mean, it's even more amplified. But what's interesting about that is the dynamic where people attack is often because they themselves have an opposing position.
Of course,
right? So So what happens is, and this disclosure point is important. Those that are often the loudest on Twitter, they're not disclosing their positions, right?
No.
I mean, so there is this kind of interesting dynamic where there is a lot of not necessarily misinformation, but incentives are not aligned because people are just talking up their own books.
Yeah, that is definitely the case, I think.
Okay, so let's talk about. Now, I was traveling yesterday, and I was rage tweeting from the flight back to New York, as I tend to do because I was bored then. But let's talk about some macro here for a few minutes. Looks like everyone got surprised by the inflation print. I had noted multiple times on my feed that there's a lot of recency bias going on this year in terms of the number of weeks the S&P has lost money, most since 1931 as a percentage of the year, unrelenting conviction that things will only get worse that made us due for some kind of a surprise for the bulls, which is this whole melt-up argument. I want to hear your take on the market's reaction to the inflation data. This can maybe persist because seemingly everyone is offsides on this.
Yeah. Obviously, the hope was that the aggressive Fed rate hikes would eventually start to work their way into the system and more than just the impact that it's already obviously had on the housing market. And I think there was an expectation that there would be a deceleration in the increase of consumer prices. But I don't think anyone was predicting a 7 handle year over year for CPI, let alone 7.7. So that I think was just such a pleasant surprise. And the hope, the market's always a lot of times about hope. The hope is that that trend continues. And of course, no one in their right mind thinks that we're going to get back to 2 to 3% inflation anytime soon. But if 7.7 becomes 7.5 becomes 7, and then we start getting into the sixes, we're at least going in the right direction. And then I think the the knee-jerk reaction is, okay, the Fed will now start to worry more about the employment aspect of its mandate than price stability. And eventually, since we know that jobs are a lagging indicator, you're going to see an uptick, further uptick in the unemployment rate. Most likely, jobs growth is going to slow. And then that means the Fed eventually pauses and then potentially even cuts rates. Is that a late 2023 story? Perhaps. We'll have to wait and see. But I think that's what the market was grasping at yesterday for that huge rally. And of course, there's short covering involved and other technical factors at play too, I'm sure.
Has it been harder over the last year to find optimists when you try to go out and source information for news pieces that you're doing? Because the narrative has been pretty unrelenting. We're in this persistent high inflation for a while. It's not transitory. And I keep going back to nobody knows what tomorrow brings. And it's maybe everybody's going to be wrong on that as well. Talk about, from a sourcing perspective, what's been the mood from the various people that you yourself interview?
Yeah, I think still a fair amount of skepticism about not just the economic outlook, but the earnings outlook as well. And that is, I think, still baked into the markets to a certain extent. The challenge as a reporter is that there are always some people, and this happens with both sides. There are some people who are perma bulls, and there are some who are perma bears. And as a financial journalist, you have to be wary and take some of the things they say with the proverbial 1 billion grains of salt, because those people are eventually going to be right occasionally, but it's the kind of broken clock is correct twice a day type of scenario. Yes, there are people who think that stocks are going to go up, and maybe right, but you might have a gigantic bear market that they didn't call or just ignored. And by the same token, there are some perma bears out there that when the stock market does go down 20%, they're like, see, I told you so. But they sat out the previous maybe doubling of the S&P 500 in a 10-year period. So you have to find people that are willing to change their mind because of the data. But that also presents another challenge. Not to knock Jim Cramer on CNBC, but I think one of the biggest criticisms, and you see it on social media, is that he is all about whichever way the prevailing wind is blowing. And it's like, it can be tedious to be always following the tape. You do have to take a step back and try and come up with some analysis and not just say the sky is falling as the Dow is down 1,000 points. And now it's, sunny skies are here again because the Dow is up 1,000. You need some more nuance, I think.
Yeah, and nuance is certainly something that's hard to get across, in all forms of mediums, especially I think on Twitter, because you end up having a lot of people just responding to tweets that don't necessarily get you to the full way of thinking in terms of how the tweet's written to begin with. From that angle, let's talk about FTX for a moment, because I joked yesterday. It's like, remember FTX? Yeah, me neither. And that was after the CPI print. And I've made this point multiple times. CPI is going to be more important than FTX. I want to hear your take on what exactly happened, because I think it's a story we keep seeing continuously in the crypto space, this kind of leveraging that ends up creating these busts. But talk about what got us to this place with FTX, and if you think that from what you're seeing, it's emblematic of other problems that have to be addressed at some point in the crypto space.
Yeah, I mean, the thing that I find interesting is that FTX was able to come up with this private market valuation and have hopes that they might go public. And it may not necessarily be fair to say that it was completely a house of cards, but obviously there was a lot of thin air there. If this company could collapse in such a short period of time, it does beg the question of whether or not a company that wants to be an exchange should also be managing money, running a hedge fund. And I think that's something that investors in future crypto giants, whoever they may be, need to look at pretty closely. What I'm trying to ascertain, and I think a lot of my colleagues, is this a contagion type moment? Do we need to be wary of what could happen to the financials? Or is this contained? And, I hate to use the word contained because it brings up the Bernankeism of subprime mortgage likely to be contained when it wasn't. Will other big financial institutions get hit by this? Or does the fact that so many big banks and money managers were really wary of crypto and just dipped their toes in gradually into those waters, does that save the broader markets and economy? Because this might be something that is really just a problem for super crypto bulls and not your big banks and average consumer who may still look at Bitcoin and other crypto skeptically because they say, at the end of the day, when I'm going to Walmart, what am I paying with? Am I paying with a debit card that is back to my bank account denominated in US dollars, or am I paying with Dogecoin? If you're not Elon Musk, you're probably paying with your debit card backed by the US dollar in a bank account that's FDIC insured. I'm talking like average consumer versus the real crypto evangelists, of which obviously there are a fair amount.
So I brought up this point a few times that, at least on the first wave or major wave lower that happened in the crypto space, I've referenced the idea that we don't know it back then, obviously didn't play out, that if a crypto collapse would cause a contagion or cause another financial crisis, just because, a margin call in one asset class is never just isolated to just one asset class. When it came to Lehman Brothers, people forget that the market didn't really crash until a week after Lehman filed, right? It was not like coincident. There was a lag there. And I only say that because, you have to always consider all possibilities. It's, you never know if this stuff ends up having negative consequences on stocks with a lag. I don't think so this time around because the inflation data, I think, will overwhelm it. But it is interesting how people, I think, react and perceive these events as they're unfolding. Did you find that in terms of viewership, more and more people have been trying to look up articles that relate to FTX, that relate to crypto crashes, just because it's such a sensational type of thing that's going on?
Yeah, I mean, it goes without saying that in the media world, financial media as well as mainstream media, there is the quote, if it bleeds, it leads, and I think that does to a certain extent extend into financial journalism, that there does typically seem to be reader interest more intently on the days when the market is crashing, as opposed to a day like yesterday when stocks were roaring. Of course, you want to have the good news and the bad news equally that you're presenting, and readers do need to see that. But I think anytime there is a negative headline, it is something that typically more readers are going to be interested. And I think, I think an investor is always more interested, and because they're worried about what their portfolio might be doing on days that are down than days that are up, that they're not necessarily coming to celebratorily click on a headline about the Dow surging, but they're more nervous on the days when the markets are tanking.
I keep referencing this idea that there's never just one cockroach in a hotel, and we see these stories pop up of fraud and all kinds of things in the crypto space. I'm curious, do you think that we're closer to the end of these types of headlines, or do you maybe yourself get the sense that we're still going to see more of these blowups in the coming future?
Unfortunately, I think it is the latter. I think, obviously, if a company like FTX was in such a precarious state, it leads you to wonder whether or not some of the smaller companies within the crypto world are, equally in dire straits. So I think that there are more shoes to drop, especially since Sam Bankman-Fried was, you could say for better or for worse, but it does seem like worse now, the banker for many struggling crypto companies he was trying to prop up. So, you pull the curtain away and, the proverbial Wizard of Oz is just a normal man. What does that mean for all these companies that might have been lining up for some of that Sam Bankman-Fried FTX cash, which no longer really exists? I mean, obviously FTX, they filed for bankruptcy. They're not in a position anymore to be lending to other struggling crypto firms.
Where was the SEC throughout all this? Because I think this is one of those frustrations. Yeah, somebody who's in the industry is regulated by FINRA and by the SEC. You know, a lot of this stuff seems kind of obvious. Like a lot of this stuff doesn't really pass the sniff test if you just do a little bit of analysis, right? So is it a function of the regulators are overwhelmed, they're not paying attention, there needs to be more resources? I'm curious from your perspective because, this is not something new. You can go back to the days of Enron, right, and see failures of regulation to prevent this kind of stuff.
Yeah, the regulation angle is very interesting. I mean, one of the issues is that some of these companies weren't really under the purview of regulators to the same extent that big banks were, that have to report to the SEC, the FDIC, the OCC, all these other kind of alphabet soup Washington agencies that regulate mainstream financial institutions, and obviously the Fed overarching as well. What I find interesting is that keep in mind that so many crypto bulls, Bitcoin evangelists, their whole bullish case, their shtick, if you will, was we are not regulated. We are not beholden to the same rules that big banks are. We are not a fiat currency. You don't have to worry about a central bank printing money and destroying the value of these assets because it's all about blockchain and a fixed amount of currencies that are going to be mined. And that's all well and good. But I've talked to a lot of people in the past few years who've been a little bit more reasonable within the crypto space and have said, we're not completely oblivious to the fact that this is still wild, wild west days. We welcome reasonable regulation. We don't want something that's going to thwart innovation, but having something that can prove to average consumers and investors that this is not just fluff, that there is a real substance to cryptocurrencies, that's not the end of the world. Validity isn't something that you should shy away from. You should crave it. And I think it's going to be interesting going forward whether or not new crypto leaders are going to call more for that validation to basically say, hey, we're not FTX. We're a real company. This isn't all just, a shell game, if you will.
Yeah, I mean, everybody loves free markets and capitalism until there's pain, right? I mean, that's just the reality, right? And unfortunately, I mean, for me, the real problem, as I see it, is you end up having a lot of false narratives, and you don't really. I mean, I think the real key regulation that needs to be put in place is leverage limits, right? Because at the end of the day, and this is what's challenging with something that's a globally traded, 24/7 asset, right? The dilemma is you end up having social media driven by bots, you can argue largely, but also some very large accounts that basically say this crypto is going to go to the moon. Everyone ends up levering it up because they want to get rich quick, and then everyone's left holding the bag on the margin, collateral call, right? That ends up happening. The dilemma is I don't know how you can possibly regulate leverage on a global scale, right? Because you may not be able to leverage up more than 2x in the US, but you might be able to do it in Cyprus 100 times x, right? In Bitcoin, right? So and that to me is always what's sort of a problem for the argument of institutional adoption. In order to get institutional adoption, you have to have some false sense of confidence around modeling what future expected returns are likely to be. You can't really do that if you constantly have these tail events.
Yeah, it really becomes difficult, if not impossible, because you are going to have a scenario where people get scared and nervous by really negative apocalyptic sell-offs and headlines to the extent that they will then sit out a legitimate rebound and rally and only get in too late, if at all. I mean, we obviously saw that in the wake of of several crises in the financial markets in the past 20, 25 years since my career began. We saw it after the dot-com collapse. A lot of people were very skeptical of big tech firms and missed out on a rebound rally. We saw it in the wake of the collapse of Enron and Tyco and WorldCom, people starting to to doubt whether or not the books of any legitimate Fortune 500 company were real or if they were all being cooked. And we obviously saw it after the global financial crisis too. But it is not easy for an investor to get back into the markets when it seems as if the worst is still yet to come. But sometimes you have to take that pain with the notion and the hope that things will turn around. And you know what? If you get in a little too early, and you going to really kick yourself by saying, if I had only waited and timed the bottom exactly, I would have not lost that 20% on paper. You can't really do that. If you are a firm believer that things are going to bounce back, you have to get back in before it's too late, when everyone else already knows that things have bounced back.
Right. No, that's exactly right. Now I'm curious, are there any parallels to the tech bubble, right? Because you lived it, you experienced it, you wrote about it, you covered it. Any parallels with what's happened in the crypto space and also in technology, which we'll talk about next, to the tech bubble, back then?
Yeah, I think that hopeful that I'm not drinking the proverbial Kool-Aid here. What I think investors and consumers should keep in mind is that as bad as this FTX situation is, you shouldn't label the entire crypto industry as as fraud. I think two things can be true. FTX shouldn't have had a $32 billion valuation, but you could still be bullish about the future of Bitcoin and other leading digital currencies and blockchain technologies. And I think the same thing was true in 2000. You could say that Amazon at the time was insanely overvalued, but that didn't mean that Amazon wasn't eventually going to become a juggernaut that would lead the world of retail. And no one could have predicted probably in 2000 what cloud computing would do to Amazon, and how AWS was going to become such a major moneymaker for that company as well. So I think people have to separate that something can be a bubble, but can still be a legitimate long-term trend. It's just that people get way too excited and valuations get insanely out of whack.
That's I think a good transition maybe to tech today. But before we talk about what's going on with tech, everybody here, please make sure you follow Paul R. LaMonica. You can obviously check out his numerous writings on CNN Money. Everybody, please make sure that you continue to support this effort and check out Lead Lag Live also on all your favorite podcast platforms. All right. Now, I have to tell you, it's interesting to me the way that people have perceived this bear market. A lot of people, I think, have argued that the bear market started December, January. I've argued for a while that the real bear market started February of 2021, because that's when breadth peaked, small caps went sideways, emerging markets peaked, ARK peaked. The large cap tech names largely held. So it looked like the S&P and NASDAQ were fine, but everything else beneath the surface was really deteriorating much, much earlier. And a lot of that is because tech is what held the market higher, held the market up. And a lot of people are still of the mindset that tech is going to keep on pushing us lower, even though, again, you've had this prolonged decline, I'd argue, in the average stock. We're seeing headlines around layoffs. Talk through to the audience some of the work that you've done on the health of the tech sector fundamentally, if these layoffs are still just getting started, and what maybe investors should think about as they're evaluating some of these mega cap names.
Yeah, definitely. We see in a business, we have a whole tech team, and they've been focusing very closely on what's happening at Meta, the old Facebook, what's happening at Amazon and other large tech firms that have been announcing various restructurings and layoffs. I think what really investors have to try and ascertain is the tech sector was a leader for so long. It's hard to really know if they can bottom in just 1 year. I mean, of course, the calendar is an arbitrary construct with regards to whether or not, the end of a bull run or the end of a bear run is over. I mean, just because January 1st, 2023 is around the corner doesn't mean that all of a sudden, okay, well, all those tech layoffs and tech valuation resets that was confined to 2022, it's now over. we have a fresh start. I think you just have to look on a case by case basis. I mean, the thing that I really have been struck by in the past few years is that so many investors seem to be more inclined to really invest in the passive ETF way. And that's great, but I think there still is a role in the world for classic stock pickers, and not every company is going to be doing as poorly as others in the tech industry. And there will be some that might even do well. So the Warren Buffetts of the world, they sometimes get made fun of as being anachronistic, dinosaurs, but we still need people that are going to try and identify good companies with solid fundamentals, healthy balance sheets that are trading at reasonable valuations. You can't just basically say, I'm going to buy the QQQs and then that's it, call it a day.
Do you get the sense that this is more idiosyncratic than macro driven? That because you're seeing some of this data around usage around social media platforms dropping. I wonder if it's more just we sort of reached a natural peak and saturation point with social media usage.
It's possible. I think that we haven't touched on this yet, but the rise of meme stocks is something that also speaks to the notion that places like Twitter and Reddit and others that there are maybe some instances of social media saturation. And bottom line, it's all about, I think a lot of times, investors just looking at charts and momentum and not as much fundamentals. And I think that's really, I will fully admit my bias. I started in financial journalism, like I said, in 1995. And what I did was I tried to talk to as many people as possible that were either respected analysts, top fund managers. And by and large, it was about, what's the earnings growth look like? What is the PE multiple? I really kind of dug in from a fundamentals standpoint. So I know there is a place for quants and charting, but I firmly believe that if you want to be a long-term winner in the markets, that you obviously need to have a bare bones understanding of fundamental research and investing in quality companies that trade at reasonable prices. I mean, I know GARP might be an antiquated notion in a market like this, but I think there's still a place for it.
And obviously, when we talk about big tech, I'm making the argument with social media as a different segment of that with Meta, with Twitter. I want to hear your thoughts on Apple for a moment, because that's always the company, the stock, the juggernaut that everyone focuses the most on. You got some of these slowdowns on iPhone sales. Do you think we maybe have reached some kind of saturation point also when it comes to the smartphone marketplace, or is that still on track for longer term growth independent of the macro environment?
It's tough. I think that there's a saturation in the sense that you're never going to need more than one smartphone at any given time, even if you do the work versus personal one, because odds are you're only buying one for yourself, and I guess your corporation's buying the other. So of course someone's still spending the money on it, but how many devices do we really need, and how often do we need to upgrade when the changes from one iPhone to the next or one Android phone to the next are more incremental? I think that what Apple is trying to do, and to their credit, they've done a decent job of it, is hooking people on all these various services so that you get that subscription revenue that's recurring. That obviously helps the Apples of the world. But I struggle to think, and I'm not by any means a technologist, what is next? I mean, what is going to be the next big consumer device that either Apple or Alphabet or Samsung or another hardware company is going to invent that will become at some point a ubiquitous device that we're all walking around with? Because obviously for a while it was MP3 players like the iPod, and then that you didn't need that anymore because you wound up having a smartphone. What really is next? And I honestly don't know. I'd be lying if I said the next big consumer gadget is this. But we need a next big consumer gadget because it's getting tiresome to just basically say, oh, look at my new iPhone, which is just a tiny bit better than the one I bought 4 years ago.
Yeah, no, and this I think it gets to sort of the heart of what could be a secular change that's happening beneath the surface of the market, which is to say that really since 2012, 2013, it's been all about the S&P because it's been all about the FANG names, right?
Yep.
And these mega caps, which I mean, at some point you have a problem of size, right? It's hard to grow, at a 10% clip when you're a multi-trillion-dollar company. With higher rates, the argument you keep on hearing is that, this is what makes it very hard to be a tech investor. And these higher rates are probably going to stay with us for some time. It could be that all this is actually very good for everything else beneath the surface, because if money is not going to chase failed momentum in Apple, it might chase, many more smaller cap companies, which I think partially could explain some of the breadth that we're seeing, off of the low from October 2nd, October 3rd.
Mm-hmm.
But you and I both know it's going to take time for investors to change their mindset to think differently about where to invest. So, how do you, from a journalist standpoint, focus on things that people are not maybe focusing on, right? Because Apple's always going to get clicks, Tesla's always going to get clicks, right? But that may not be where the real story are going to be going forward.
Yeah, it is a delicate balance because full disclosure, I work for CNN, which has a business audience for the CNN business website, but a broader mainstream audience, both on TV and digitally as well, that may not necessarily be all business all the time. So the types of things that by that nature I write about are not always going to be the same as CNBC, Yahoo Finance, and other big financial news oriented sites would be. Like I often joke with editors that there are great stories that I think could be fun to do, but that forget about them being inside baseball. They might be inside lacrosse or inside another sport, not to make any light of lacrosse, but inside another sport that is far less popular in the United States. So we, as financial journalists, we have to know our audience, and that can sometimes be a broader audience, which might mean that for better or for worse, a story that I write about Apple and Meta is probably going to do better than, hey, here's this great micro cap opportunity that could be the next 10x banger. I mean, I'm not the Motley Fool. I'm not writing for that audience. Not to at all denigrate the Motley Fool, but you have to know your audience, and that means knowing your editors as well as your readers.
Yeah, no, 100%.
Financial journalism inside baseball.
Right, no, 100%. But it's interesting because also, you talk about sort of, I think you said the term, the sport of it. I mean, the part of this is also maybe even relating this to politics, elections, right? Because, the average Joe may not necessarily understand markets, but they'll always have an opinion on politics. I am curious if you're seeing more and more people wanting to bridge the gap between what happens during the midterms and obviously during the next presidential election and the stock market, even though history would suggest there really isn't that much of a close link as people think. I got to imagine that people still want to talk about it.
Yeah, I mean, people definitely want to talk about what a Biden second term would mean for the markets versus what a potential Trump, if he decides to run again and win, or DeSantis or other leading Republican potential contenders, what that might mean. I mean, obviously, we're still very far away from even in its infancy sort of stages speculating about 2024, since, who knows who's running on both sides, because I don't think it's a given that President Biden's going to run for re-election just yet. We'll hopefully find out maybe sometime in 2023 what his aspirations are. But it does go without saying that as financial journalists, we need to be cognizant of the fact that politics is an important story for many readers, but it is also extremely emotional. And we need to try and detach, as you point out. I mean, it's good and smart and responsible for financial journalists to point out, regardless of which party's in power, that typically over time, you follow the Fed, you follow economic data, you follow earnings, and you should be okay no matter if it's a GOP White House with a Democratic House and Congress and Senate, or vice versa, or if one party controls all three. Typically, the markets go up, and when they go down, it's usually not because of a political event, at least for a longer term perspective. I mean, not to say politics can't impact the markets. I mean, the political brinksmanship that we had when the government almost defaulted, many years ago during the Obama presidency, and we lost our pristine AAA credit rating. That shows that politics obviously can have an impact on the economy and markets. But I think over the long term, it is typically interest rates, earnings, and other economic data, and not what's going on in the White House and on Capitol Hill.
Right. But as you say, there's a delicate balance because you've got to get people to want to read and pay attention to it. But so you've got to reference that because that's what they're maybe attracted to. But at the same time, it may not be necessarily important in terms of their portfolios. Right. And that's, I think, where it gets to be, I have to imagine, saying from your perspective, it's a real challenge, right? I always go back to the point. It's like, who do you blame for being overweight? The person that's ordering the food or the person that's serving it?
That is a great question. I'm not going to wade into that one. But yeah, it is a chicken egg. It's a chicken egg situation, probably. And I guess maybe if you have more of the former and less of the latter, who knows?
Right. No, that's a fair point. I'm curious. Are there any stories that you're focusing on that, or things that you're seeing that are maybe being not necessarily misreported, but maybe underreported, that could be bigger deals going forward? I mean, I got to imagine you've got exposure to all kinds of different thought leaders and people, and you're in this every single day. You see the things which get clicks. Oftentimes, it's the thing which nobody focuses on. That's the bigger story. Anything that kind of comes to mind for you in the most recent several months that could become a bigger deal, you think?
Yeah, it's a great question, Michael. I think that one story that may not be getting enough attention yet is this whole notion that the Fed, I mean, obviously the market's banking on it to some extent, but the Fed clearly could be in a situation where, even though Jerome Powell has been talking about how vigilant the Fed has to be about inflation, that there could be that pivot and even a sea change in monetary policy. I think some people are banking on it, but it's not totally baked into the markets yet. I think the one thing, and I wrote a story about this earlier this week, I think as financial journalists and also I think investors sometimes spend way too much time over analyzing what Fed members say and don't look as much at the data, which obviously that's what matters more. It's the reason why the markets went up as much as they did yesterday, because that CPI number was perceived to be a lot more friendly than what people had been expecting. So don't worry about what Jerome Powell says about the economy, when the bottom line is, even though he's not using the data dependent mantra as much anymore, they're still data dependent. So I think that's the thing, is that sometimes it's interesting. I find that we in financial journalism sometimes are a little scared of numbers and data because we feel that they may be intimidating and scare off investors. But I find that to be a fallacious argument when you look especially at other aspects of the media. I mean, there's a whole cottage industry that, CNN proudly, I think, has, done a great job of. You look on election night and it's all about the magic wall and like drilling down into the most arcane minutia of like county by county, state by state, what's happening with the votes. It's all a numbers story. You look at sports. Sports is primarily about numbers, obviously personalities as well. We as financial journalists shouldn't shy away from numbers. We need to embrace them because that's what tells the story.
And unfortunately, I think prices move not just based on numbers, but narratives and tone, right? I mean, algos are
Totally.
constantly reading off of these statements, and if a certain word is being said by Powell, that's hawkish. If a certain word is being said by Powell, that's dovish, and I can't imagine that Powell's not aware of that. I have this, maybe it's not, I wouldn't say it's a conspiracy theory, but I have this belief that maybe Powell last Wednesday when he came out, aggressively talking about rate hikes and sounding hawkish, which is why you had that sell-off, that maybe he was doing that purposely to game the algos to push stocks lower because maybe he saw that CPI might come in better. Or maybe, for all we know, he's trying to counter strong seasonality. Because the last thing the Fed wants is a runaway market, right? I mean, so in other words, the data that Powell is, that these algos are looking at, Powell's also trying to game the system, knowing this, I have to imagine.
Yeah, I think to a certain extent, there is clearly a sense that you would like to think and hope that the Fed and other central bankers have a better understanding and read on where the economy is going, so that even though they are data dependent, they should also hopefully be better prognosticators about said data than other people. But at the bottom line, it's the economy and markets are very dynamic, and not everyone is going to get it right all the time. So the Fed will make mistakes in the same way that average investors and pundits will as well.
How do you go about fact checking, Paul? Because there have been, I think it was CNBC. Musk got the better of CNBC with these layoffs of two people that were actors, right? I'm sure you saw that story, and they had to apologize for that because they didn't actually verify if they were actually employees or not coming out of Twitter's building or whatever it was. I'm just curious, what's your process for fact checking when it comes to putting a story together, and what kind of advice would you give those that want to enter into financial journalism to make sure that they are putting out accurate information?
Yeah, it's tough because there is going to be the constant desire on a part of a reporter to try and break news and make a name for themselves, make a name for their organization, and that pressure that you get from editors and people higher up in management to be fast. But you have to be accurate, because I'm a firm believer, even though sometimes people in my industry may not agree with me, that for the average reader, they don't give a bleep at the end of the day about scoops and the notion of being able to say, I beat the Journal, I beat the Times or the FT or whatever. Like, that's all like navel gazing media stuff. The average consumer is going to remember when you got something wrong. They are not going to remember that, oh, you were the first person to break the news about this merger nanoseconds or picoseconds before the Journal or the Times. But if you mess something up, you're going to remember, your editors are going to remember, and most importantly, your readers are going to remember, and you are only as good as your reputation. And if you don't have a good reputation, no one's going to believe what you say or find any reason to follow you. So I always stress to my editors and my colleagues as well that, yes, we want to be fast, but it's worse to be wrong than it is to be second, third, or fourth.
Yeah, and that's the challenge, right? It's how do you be fast but accurate, right? I mean, that's that, and it's unfortunate that's what is sort of the test of success. That's who can break the news fastest, not who can break the news most accurately. In the final few minutes here, again, everybody, please make sure you follow Paul R. LaMonica and check out his work with CNN Business. I obviously spoke saying CNN Money a little bit earlier, but okay, I want to end off with the housing market. You put a piece out. You spoke to a CEO of a real estate company. A lot of people will naturally make a comparison to 2008. Nothing is quite like a sample size of one when it comes to any analysis.
Of course.
Talk about just what you've heard and seen from those in the real estate market, in the home building side of things. What's the vibe? What are those that are in the arena thinking as far as this housing slowdown?
Yeah, I mean, what's interesting is that I get the sense, and I can speak to this personally as someone who moved from an apartment in Brooklyn in September of last year to a house in the suburbs. My heart goes out to anyone that is trying to buy for the first time, because I don't know how you could be in a situation where there is so much competition for limited inventory. My wife and I, we lost multiple bidding wars on houses. We almost lost the one that we wound up buying. But if we didn't have the sale of an admittedly probably overpriced co-op in Brooklyn to cash in on, we wouldn't have been able to buy the house that we have in the suburbs now. So I think that one of the biggest problems for housing is going to be that first-time buyers have to be on the sidelines for the foreseeable future unless they are lucky enough to have a lot of cash on hand because they're either super wealthy, have independently wealthy parents, what have you. You know, what I find from talking to people in real estate is that there still is a fair amount of people, particularly older Gen Xers, boomers that may be getting closer to retirement. If they bought a house in the 70s, 80s, 90s, no matter what's going on now with the depreciation we're seeing and with mortgage rates spiking, 7% mortgage rate isn't going to scare someone who got a double digit mortgage in the 80s. And if they bought a house in the 80s, it's obviously worth a heck of a lot more now than it was 40 years ago. So for people that are looking to trade down, get out of the burbs where maybe they're close to a city because it's where they worked, and they want to buy a smaller place in, sunshine states of Arizona, Nevada, Florida, what have you, that market I don't think is going to dry up anytime soon. So I think existing home sales should hold up better than new home sales. Builders, I think it's going to be tough because we did have a glut of home building. And, I think the issue is, really going to be that people are going to still be willing to buy existing homes, but not necessarily, buy new homes. That's my sense from talking to people.
Yeah, no, and that lines up with some of the analysis that I've done myself. I mean, this is the thing about higher rates. It's like already housing is going to be at a standstill. It's like you don't really need to have that much more to break the number of transactions. They're already, collapsing. So that's why I think large part of what the Fed's done so far probably not only is going to act with a lag, but may actually be closer to the end than not. But that's a conversation for another day. Everybody here again, please make sure you follow Paul R. LaManca here on Twitter. Check out his writings. Paul, first time you and I are speaking, really do appreciate everything you're doing as a financial journalist and keeping things real here for the Twitter space audience. Paul, thank you everybody for joining. Appreciate it.